This is not about market timing, which is the idea that you can perfectly call the top or the bottom of the market and either swoop in at the moment of greatest pessimism and buy the best companies on a huge discount, or manage to miraculously sell everything a day before the big crash. Our view is that trying to time the market so precisely is a game best left to magicians, fortune tellers, and the eternally lucky. But wait, if it's impossible to call the market, to judge the market in this way, why are we even talking about when to buy in the first place? Surely any one time's as good as any other, right? See, the thing is, the market's an incredibly complex, multifaceted, and deeply irrational ecosystem. Although this is difficult to prove, our gut feeling from years of experience tell us that for extended periods of time, the market's price discovery function works moderately well. There's plenty of times when the stock you like is going to be trading at a level approximating fair value, and buying a great company at a fair price is always a pretty safe call. However, this is not always the case. Often investors are possessed by a spirit of exuberance elevated to a sense of outright euphoria. Everything in the world is wonderful, the trees and the hills are alive, and all the stock prices are flying up. Times like this are referred to as bull markets, where we have elevated valuations and sky-high share prices. Extreme cases of this are referred to as bubbles, a topic we will touch on in other videos in far greater detail. Some notable examples of very bullish markets include September 2007, just before the US subprime mortgage crisis, August 2000, the last flourish of the dot-com boom, and January 2022, immediately after the massive COVID-19 stimulus and before runaway inflation emerged. In contrast, there are equally periods where investors are sad. They are struck by a sense of pessimism, fear, and quite often panic. These are referred to as bear markets, where prices are doing... Notable examples include February 2003, just before the invasion of Iraq.
Just about 10 minutes away from a speech, President Bush addressing the nation on television, giving Saddam Hussein a deadline.
February 2009, at the height of the visible damage caused by the global financial crisis.
This is going to be one of the watershed days in financial markets history.
As well as March 2020, when the market was in the grip of the COVID-19 pandemic panic.
We have seen shortages in the travel industry. We have seen shortages in the healthcare industry.
At these times, even the very best companies can be trading at the bargain basement prices we alluded to earlier. So okay, we know there's bull and bear markets, and there's going to be times where stocks are relatively over or underpriced. Can't we just sit and wait for bear markets and put our money into the market then? Well, how long do you want to wait? See, obviously extremely disciplined and patient investors can wait for the next bear market and benefit from the associated attractive prices. The problem is, no one can tell you when the next opportunity is coming, although there are plenty of market strategists out there who will tell you that they know. They don't.
4, 3, 2, 1, boom!
On this point, we're reminded of the old saying that pessimistic economists have predicted 8 of the last 2 recessions. Another thing to consider here is the opportunity cost. Imagine for a moment you have money earmarked to invest sitting in a bank account making almost no return. If you wait years and years and years in order to buy shares at a more attractive price, you're going to miss out on the money that would have been generated by owning shares in that time period, both in terms of the dividends you may have received, but also in terms of the retained earnings within the business itself. So in our view, if a company's trading at a fair value, we like the company, we'll buy it. The benefit of owning the company for the long term is what we're here for anyway. Getting a nicer price to enter is great, but it shouldn't stop you from buying it if it's at a fair price. So what happens when we buy or own a company and the share price starts falling? This is, of course, great news. Great news. If you take away one thing from this video, hell, maybe even this whole channel, understand, please, falling share prices is great news for investors. Why? Why is that? Well, pretty simple actually. They're cheaper to buy. The only times a share price matters is when you're buying or when you're selling. And the rest of the time, it truly couldn't matter less. Imagine for a second there's a man who comes to your door and offers to buy your grandfather's antique clock. And every day he gives you a different price. You're not forced to sell the clock. You can keep the clock for as long as you want. You could buy another clock. You could start a clock collection. But the whole point is that the man will always come back to the door, he will always offer you a price. Let's say that price was $1,000 one day, $1,100 the next day, then it went down to $900 the day after that. You would not sell it at $900. It doesn't make any sense. This is a very quick rendition from me of the tale known as Mr. Market, and you can look that up in your own time. The key point being, it is only when you buy and when you sell that the stock price matters. The rest of the time, it is a complete irrelevance. What does matter is the performance of the company in the short and the long term, but especially the long term, seeing as we're trying to make long-term returns in our investments. But from the buying side, think of it like this. You go into a shop, you see an item you really want to buy, it's at 100% price. Maybe you'll buy it if it seems like fair value. If it was then on sale by 20-30%, you wouldn't storm out the shop saying, well, I'm not buying that. This is good news. It's the thing you wanted for less money. It's good. And yet, the stock market is topsy-turvy, upside down for most investors when it comes to this subject. They see the price go up and they want to buy it more. They see the price go down, they want to sell it immediately. It's a bizarre misevaluation of what stocks and shares actually are, or at least that's what we think it comes from. A discrepancy from investors treating their shares not as owning part of a company, but as a purely speculative asset. They act as if the share price is just a number which randomly goes up and down without any real relation to what that number actually denotes, the value of a company. So if the stock price falls either through general market weakness or through stock-specific reasons, look to buy more and don't panic. I feel like I'd team up with the Hitchhiker's Guide to the Galaxy. Don't panic. Don't panic. We're assuming you've already done the hard work of establishing that you want to own this company and that you retain your faith in the investment thesis, i.e. the reasons why you want to own it. On the other hand, if the market suddenly develops the hots for your favourite stock, what should you do? So many people, if they own Apple and Apple starts going up, they want to buy more. It's a fear of missing out and getting swept up in the tide. You should be looking to do the opposite. You should be looking to sell. Now, to be clear, this is selling if you consider the stock to be seriously overvalued. Even if it's a great stock, the idea is you can sell now and buy back in some time when the stock is at a more attractive price again. To throw another old adage at you, no one's ever gone bust taking a profit. It's also worth noting that there might be other opportunities out there that are at a more attractive price. There isn't only one stock on the market after all. So how can you tell if a stock is seriously overvalued? One example is the price-earnings ratio. If you're only having to pay 10 times a year's profits, a PE ratio of 10, to buy a bit of a company which looks set to have 30 years of profitable growth, that's pretty attractive. If you're having to pay 40 times this year's profits, a PE ratio of 40, to buy 30 years of futures profits, that's less compelling. But there are also non-arithmetical signs you can look for. So if a company regularly tops the most frequently traded today table on your favourite financial site, or starts featuring heavily in social media stories, think of weight loss drugs in 2024 for example, it's a signal that it's acquiring momentum of its own, and said momentum can sometimes lead it to levels with little relation to any reasonable evaluation. In 1929, before the Wall Street crash which preceded the Great Depression of 1930s, the shorthand for stock market euphoria was the mythical hotel bellhop boy, it was usually a boy, who wanted to discuss the market with you as he carried your suitcases up to the room. Today, if your Uber driver has great tips about crypto or your mum has this company she really thinks you should own, beware. If you're not confident about a lot of trading activity or simply don't have the time, then owning a great company and not touching it for decades is a perfectly valid strategy, which will result in pretty good long-term results. The volatility we highlighted earlier appears as a tiny blip on historic price charts of a world-class company, or indeed of the major stock indices themselves. If you're able to blank out this short-term volatility and ignore all the noise, your investment returns will be more than acceptable. There are a lot of people out there that think they can see patterns in historic share price charts and use them to analyze and anticipate future share price performance. Proponents will swear to its effectiveness. Detractors will say it's like reading tea leaves. We are pretty skeptical. This isn't to say you ignore price charts entirely. Long-term data charting where a stock has traded historically is useful for all sorts of reasons. Studying share price history can alert you to opportunities. Say you consider a quality company to represent an excellent investment opportunity. The share price is $20 and appears to be an attractive valuation. Looking at the chart, you can see the stock was actually trading at $30 6 months earlier. 10 years before that, the stock was at $10. Reading on, you see the company disappointed the market with a soft trading update earlier in the year, and having thoroughly researched the circumstances, you conclude that the problem is short-term in nature and the market is overreacted. This would represent a great buying opportunity. Bear in mind though, the stock price can always fall further. If the problem affecting the company persists longer than expected, the price will invariably fall more. Don't beat yourself up. Buy a few more at an even more attractive price level. Remember, the market is typically focused on the importance of short-term issues and often ignores the long-term fundamental strengths of a business. We have a strong preference for are companies where if the share price halved tomorrow, we'd be happy to double our holdings. And this is a pretty good marker for quality. If you do end up topping up your purchase once or twice on the way down, your average buying cost is going to be lower. If you go back to the example we just had, if you buy at $20 then top up at $15 while still believing the long-term fair value is around $30, your eventual profit on sale just widened. Similarly, when you come to sell, there's no need to wait till your estimate of the top of valuation of a share. If it quickly recovers to $27 and you could use that cash invested to buy something which looks cheaper, there's an opportunity to take some profit by selling a few of those shares while retaining the balance. A word of warning though, we've had plenty of experience over the years of buying companies that looked cheap, only to find out they were cheap for a reason. These stocks are known as value traps. They can fall a long, long way. Sometimes they will fall all the way to zero. In 2024, well-known US names going bust included Spirit Airlines, TGI Fridays, and Tupperware. Quite disturbingly, I bought a TGI Fridays meal from a supermarket in a pinch not that long ago, which kind of worries me. Another pitfall to avoid is when there's a fundamental change in circumstances for a stock that you own. So if the fundamentals of one of your favorites permanently changes for the worst, or you lose faith in the integrity of the management team, it's often better to cut your losses and sell. What constitutes a permanent change in circumstances? A change in the law banning your product or service. Good example would be Wonga, a payday lender that was banned in the UK. Or the emergence of a serious, well-financed competitor. For example, neither BlackBerry or Nokia really competed very well when the iPhone came out. Or a failure of phase 3 trials of a highly promising new treatment from a biotech company. This one, there's just too many to name. Another solid word of advice, and this is financial management as much as anything else: never buy stocks with borrowed money or on margin. In fact, investors should always ideally be keeping some sort of spare cash or cash equivalents, dry powder if you will. If a stock falls materially based on short-term negativity, the last thing you want to be is a forced seller at a depreciated value because of a payment deadline or being on margin call. And it's worth noting this is a position that people do find themselves in. So when the share price falls about 10%, you're going to find it falling a lot further than that. And this is where we as investors can often get our good value purchases. People being forced to sell because they're on margin call. Meanwhile, we sitting with our money ready to go are able to buy these good quality companies at attractive prices purely because people in the market are borrowing their way in and are forced to leave at a very suboptimal time. Now look, if you don't want to devote any time to researching companies, staying in the loop, being able to be aware of circumstances and when it'd be a good time to buy, sell, when companies have changed permanently, there are also still things you can do. The first thing is, instead of buying any particular companies, is buy a wide selection of companies, also known as an index fund. Even for experienced investors, this can be useful, as sometimes there are markets you want exposure to, but you're not all that confident in picking particular winners. Say for a random example, you believed in the future of the Indian economy. How do you know which Indian companies you want exposure to? Perhaps it's better then to just own the Indian economy as a much wider band via an index fund. If you buy an S&P 500 index fund and the stock market's doing well, you'll do well. If it's faltering for a while, your investment won't look great, but over the long term, it'll most likely recover. And if it doesn't, well, we're all going to have problems, don't worry about it. If you wanted to still buy specific shares but didn't want to try and research whether you thought the price was attractive or not, you could try dollar cost averaging. Simply set aside a portion of the funds you plan to invest and feed the cash into the market on a monthly basis. Spreading your investment out over a long period of time, say 2 years, the average price you pay, even through a lot of volatility, should end up being pretty fair. Probably not great, but probably not terrible either.
Not great, not terrible.
You can look at the performance of the S&P 500 over the last month, 6 months, and see big dips and troughs that look very significant. And if you zoom back out to 25 years, you'll notice you can't really see them anymore. The movements up and down have been smoothed out effectively by long-term upwards march of the index. The short-term pain would have been significant in 2000, 2001, 2003 to 5, and 2007 to 2009, and in all these cases the market recovered and went on to post new record highs. Something useful to remember for the next crash, perhaps. With all this being said, your decision to buy or not to buy should be based off your own evaluation of the stock, not following the herd mentality when everyone buys and everyone sells. It should be based on the long-term outlook of that stock, and more importantly, the company that stock represents, which sounds obvious, but believe me, many people still don't get that. In our combined experience, the single hardest thing to get through to people about investing is this idea that stock prices of stocks you own going down can be a great opportunity to lower your average cost of investing in the stock, rather than being a terrible piece of news where you must sell them before they go down further. The stock market's full of people and even institutions who do this for a living who panic regularly and who don't really sit back and take a long-term view of things. With this in mind, the intelligent investor can absolutely take advantage and find themselves nabbing a couple of little bargains. We hope you enjoyed this video about when to buy stocks. If you're looking for more information, how to evaluate stocks, how to avoid many of the pitfalls and traps in the markets, who are the disingenuous actors in the market, all these other details, many more things, then please do follow along with the channel. Give us all the YouTube things, like, comment, share, all that kind of stuff. It really helps us out, and we will see you in the next one. Take care.